Welcome to Mogobe Nuggets of Wisdom podcast. My name is Mompoloki Lerumo Mogobe. Our objective is to enthuse, inspire, energize, and empower entrepreneurs and entrepreneurs of all stripes here in BW and beyond. We do so by inviting these entrepreneurs into our makeshift studio. Sometimes we call them to the restaurant, sometimes we go to our studio, and we ask them to share their experiential knowledge, their experiences and their expertise, and we ask them as many questions as we can, aimed at empowering you also as a viewer. Hello dear viewer, dear listener, welcome to yet another exciting episode of Mogobe Nuggets of Wisdom podcast. I'm your host Mompoloki Lerumo Mogobe. It's always a pleasure to bring you life-changing, impactful information on entrepreneurship. And today I have a wonderful guest who's going to talk about all things capital, and her name is Mythri George. Would you care to introduce yourself in greater detail, Mythri, and welcome to Black.
Thank you so much, Mogobe. It's a beautiful studio, and hello everybody. As Mogobe has said, my name is Mythri, and I am an accountant by profession, but a social enterprise believer at heart.
Yeah.
I trained in chartered accountancy with CIMA, ACCA, and I'm a fellow member as well of BICA, the Botswana chapter of chartered accountants, which is itself a member of IFAC. But apart from my accountancy background, which I gained or got experience in over 22 years odd, I'm also very keen about the ideas of social financial inclusion, about social enterprise actually being commercially viable and achieving a triple bottom line that is sustainable. I've spent just a good over 30 odd years, give or take, coming into and out of Botswana. And this is really where my heart is. And I think we're poised at an amazing inflection point for Botswana's history, where a traditionally paternalistic and beneficial government is starting to see that the roots of enterprise and entrepreneurial spirit are taking hold. And I think that what we are then going to do in the next coming decades or so will shape the future of Botswana's economy. So it's an exciting time for me.
We're going to talk about capital, and we're going to talk about the 6 points of capital and how entrepreneurs can empower themselves and position themselves with the knowledge such that they improve their chances of success when they get out there into the marketplace. I think a good starting point would be to define the subject, your understanding of capital, and why it's so important to entrepreneurship.
Yeah, thanks, Mogobe. And I think that's a brilliant point. When I was still at Lerumo, in fact, and we were looking at our integrated reporting for what is arguably a very mature multinational, right, that plays across the African subcontinent, we came across the 6 capitals thinking. And I really would like to impress upon all of your viewers and anybody else that you or I come into contact with, even through our work as angels, that the thinking about the fact that there are various forms of capital, first of all, not just financial, and also the thinking about the fact that those capitals cost something, whether it's time, money, or intellect, or anything else, even relationships, that those then need to be invested and a return acquired over those capitals in order for a business to be truly and holistically sustainable. So those 6 capitals that I certainly feel very passionate about, making sure that all entrepreneurs have an understanding of, and also then actively are tracking and growing, are, as we said, not just the financial capital, which is the first thing that comes to our minds, but also then there's the element of human capital, talent that you use in a business to take it from point A to point B. You're also then looking at intellectual capital, which is slightly different from human capital in the sense that you can protect IP, and you're a lawyer by profession, you know all about that.
Yes.
But that can come from various sources, right? And then you can manufacture capital. So like we see here in Black, food is manufactured. And that's actually a form of capital because you put resources into it and you then seek a return for it.
Okay.
Before
we dive in, you mentioned something about us as angels.
Right.
A viewer may not know. Perhaps you could just take a moment to explain what we are as angels and the role of angel Botswana network,
Yes.
what we are, ABN is all about and so on.
Right.
Angel Network Botswana is all about.
Yes.
So that they really appreciate why capital is so important and why, as angels, we consider it to be one of the important pillars for entrepreneurship.
Yeah, absolutely. So typically angels are a class of investors that you will find in most economies across the globe. And there's no exception to the fact that in Botswana, we as angel investors are looking at participating in that point in the life cycle or period in the life cycle of enterprise where it's post-startup. So it's a startup that has some sort of traction, but doesn't yet have enough of a consistent track record to still be able to merit getting funding support and other forms of support from venture capitalists, banks, and other major or commercial funders. So we as angel investors come in, we put our personal capital in, we take significant levels of risk, but in return we look for significant levels of return. And this is coming back to the capital's thinking. We don't just look for financial return as angels, right, Mr. Mogobe?
Yes, correct.
We're often, and I know this is something that drives you as well, and it's something that binds many of us angels together, is we're looking to make social impact. And for us, that's a form of return.
Yes.
When you see that you have employed young Botswana men and women, or talented people generally, and you see them moving forward, that's a form of a return for you.
It's
in terms of
gratifying.
absolutely, and in fact probably is even less quantifiable than the financial return, but so much more important. So we as angels come in at that sort of point in the life cycle of an enterprise where otherwise they may well have entered what's known as the valley of death, but because of our mentorship, our networks, our interest in...
What is it called, the valley of death, by the way? Sorry to have interrupt there.
I think it's called the valley of death because you're sort of going on a slight incline, but there's that precipice point where if you aren't careful about who you get your funding from, getting the funding itself, having the right support, the right networks and mentors, the intellectual capital and human capital support, you can literally drop. And when you drop at certain
It's like jumping
points,
off the cliff, right?
absolutely. And at certain points when you jump off the cliff, there is no safety net. Certainly when you're a startup and what you've got is just a little bit more than an idea, a functioning idea, it's very easy to perish. So we as angels come in at that point, and as long as there's a real commercially workable idea that a return can be generated from, that we resonate with, that's where we want to play. And obviously then the off-takers become your venture capital players, your private equity firms, your banks.
The first nugget I want us to park on, as it were, is the talk of cash.
Right.
Cash is king, cash is queen, cash is the lifeblood of business. Talk a little bit more about cash and how you see it in this context of the six pillars of capital.
Right. So yeah, I mean, we haven't talked about, I guess, the natural, social, and relationship elements of capital. But you're absolutely right that cash is king, it's queen, it's what runs through the veins of a business, just as blood runs through our veins. Oftentimes I've spoken to entrepreneurs and startup players, and they've said, listen, all I need is cash. And I've actually said to them, no, it's not. What you really need is a compelling value proposition, a sense of product market fit, meaning you know that the market segment needs this product and this is the price point. But once you've put that aside and you've bedded that down, I absolutely agree with you that if you don't have a finger on the pulse of the cash that's coming in, going out, and your balance of cash at any point in time, you cannot keep your business alive, just as if you don't have blood circulating through your body, you run out of oxygen. And so there are some key elements that an entrepreneur, once they've got the value proposition right, the product market fit right, certain elements of cash management that they cannot divorce themselves from, they cannot delegate to others.
Okay. I often say to young entrepreneurs that there's a reason why the name for cash in Setswana is the same as a name for blood, Madi. So it's interesting that you mentioned it's the lifeblood of the business.
That's a great point.
Yes.
And I never made that connection before.
Yes, yes.
But it's brilliant. Yes, I agree.
Absolutely. Now, burn, money in, less money out.
Yes.
There's an average burn rate.
Yeah.
This is something that you can actually study and quantify. Can you teach our entrepreneurs about how to actually address the burn rate situation?
Sure. So listeners, I think the big issue is really that you've got to, just the same way you manage how much money you have, kakarata, or in your wallet, you have to know how much money is in your business at any point in time. And over a period of time, what an entrepreneur and a business must be tracking is, given in a given month, for example, how much revenue did I collect? Obviously in the startup stages, and we can come to that later, but in the startup stages, you don't want to be giving credit terms to your customers. You ideally, if you can help it, want all of your revenue to be in cash form, right? To be paid on delivery type of thing of the service or the goods. So you want to be looking at how much cash came in respect to that revenue, how much did you spend for the business for that same period of time, and therefore, how much cash are you burning through? That burn rate then becomes something you track periodically. And if, for example, in December, we had a major legal issue, we went to Mogobe for consultation.
Yes.
And he burnt us with a big invoice, with a huge bill, but it was necessary. We knew if we couldn't do that, we couldn't move forward. So that might have caused a spike in the cash out flow. But you take an average over, say, a 3-6 month period, and that gives you an average burn rate. That average burn rate is important to Mogobe and listeners, because what it then helps us to understand is typically how much am I eating through in terms of cash, or how much am I creating as a surplus over the cash I spend. Why do we need to know that? Because that helps us understand another thing, which is runway.
Okay, I want us to talk about runway in terms of how long. Why runway? Is it comparable to aeroplanes or what?
I suppose it is, and I kind of look at it as, if you don't get off the runway, pretty soon you're going to hit a brick wall, right? And an airfield. And it's kind of the same thing here, because remember we said the paramount thing to know is how much cash you have in your bank account for your business, right? At any point in time. You take that cash balance divided by your average burn rate that you know is generally representative of what you're going to go through in a month. And that tells you how many more months you have of runway with the cash that you have.
Before takeoff?
Before takeoff. And why that's important is it then helps you, that information helps with your decision making around, do I need to go and ask more friends and family for cash? Do I need to change the terms of whether I give credit to my customers, or whether I negotiate credit terms with my own suppliers, which is an important element of working capital management? And at what point am I going to face facts that possibly some element of my underlying business model isn't working because I'm going to run out of runway?
Very interesting. Let's address the growth rate. I mean, these are things you as chartered accountants really spend a long time on, but I think you have a special interest as an angel investor to actually dig into these numbers.
Absolutely. So, typically what we need to be looking at in terms of growth rate here, Mogobe, is from month to month, week to week, even in the early periods. But then as you get a bit more mature as a startup, quarter to quarter and so on, over these blocks of time, how are key indicators such as my revenue or customer numbers, how are they growing period on period? And an important thing to understand in terms of, as you said, we CAs and statistical people like to look at, is that something called CAGR, which is cumulative or compound annual growth rate.
You have to say that slowly so that the viewer can grasp it.
So the abbreviation, because we love our abbreviations, is CAGR, which can stand for either cumulative or compound annual growth rate. And that rate is one where, say you are tracking your revenue growth over a 12-month period, and you've got 4 quarters, obviously, in the 12-month period. Your growth rate in your revenue between what you hit at quarter 4 and what you were at in quarter 1 is actually exponential. Whereas maybe from quarter 1 to 2 to 3 to 4, it's probably 10%, 10%, 10%.
Gradual.
Yes. But that's what then gives you, when you then plot it from quarter 1 to, say, a future point in time like quarter 4, it gives you what investors like to call the J curve or the hockey stick effect.
Yes, I've
when you
heard
plot
of
that growth rate. Yes. And that's typically what an investor, and as you said, angels, as we are, we like to look for. We like to look for whether there's significant upside, as we call it, after the point that we come in and inject our various forms of capital.
All right. And is it something that you're able to prejudge um, at the pitching stage of the proposal, or is it something that you really need to? You can only figure out when the business is already started.
I think that depends to a large extent on just how novel the concept is or the business is. So if it's a business that is fairly conventional, I like to use, particularly in Botswana, the idea of a hair salon. You know, because I meet a lot of people who say, I want to set up a hair salon, and I say to them, but there's one almost on every corner. So you are not doing anything significantly different. And in that instance, it's very possible to predetermine and make an estimate of what the likely growth rate is going to be in customer numbers or revenue, even in costs, frankly. But if, for example, it's a completely new concept, like let's say it's a digital app that is working on tracking the biometrics of a whole family and tracking their activities, etc., that is something that doesn't exist today.
Yeah.
So it becomes a much more nebulous concept to try to project for.
You just mentioned something about revenue, cash, and costs. I don't think an average entrepreneur really appreciates the finer distinctions. Can you spend a moment to help us understand those?
So revenue in simple terms is what you're earning for the services or the goods that you are selling, right? And we ideally want it to be such that, and that's called marginal income in accounting terms, but you want that marginal income typically to exceed your marginal cost. And what is marginal cost as opposed to general cost? It's the variable elements of what you spend in your daily operations so that you can provide those services.
Yes.
So distinctions between marginal and fixed cost are, for example, if I pay a direct sales agent a sales commission, I'm only going to pay them a commission for the level of volume or activity that they do, right? And that's a marginal cost or a variable cost because it varies with activity.
Yes.
But then I have my expensive lawyer who's on retainer and he, but in this case probably very affordable, but nonetheless it's a fixed cost because I'm committed to that. Rentals are another classic example of a fixed cost. Or if you've got installments to a bank on mortgage or asset loans, those are fixed. And what you want to get to in your business is enough scale and volume of operation that then kicks out a multiplier effect on your revenue top line, as it's called, which then you've got a good relationship between that and the marginal element or the variable elements of your cost, give you a healthy enough gross profit or a surplus that can then cover all of your fixed costs. After a certain point, when you hit the J curve as well, your fixed costs are still here, they're at a plateau, but your marginal income is here, and that's the space that a lot of investors want to play in.
Wow, that's wonderful. Let's talk about default alive versus default dead. First explain the phrase and then see how it applies to what we're talking about.
Right, so I think it tends to be the kind of phraseology that's used largely in Silicon Valley and with tech startups particularly, but I think it's applicable definitely to Botswana because, as we said at the beginning, we've reached this turning point in Botswana's own trajectory where we have so many youth, you and I have seen them through the Angel Network Botswana, who are coming through with brilliant ideas and they're innovative, right? And the issue about default alive for people like them or default dead concepts is that we want to say, if given your current bank balance and the surplus that you tend to generate every month, the burn rate that you know you have, and therefore the runway that you've determined you have at any point in time, meaning, do I have 6 months worth of cash to burn through? Or is it 9 or 12 or whatever? You then look at the default, the path to profitability. Remember I was describing the J curve of revenue. And that revenue against your costs, your fixed costs and your variable costs. You want to say that if my revenue is equivalent to the cash that I generate in the business, you make that assumption generally, how much of that do I need to get through before I hit my path to profitability? So meaning that if, say, you've got a runway of 6 months, but you've tracked that your path to profitability is 4 months, you are default alive, you see, because you'll have enough cash to cover you through the period when you're not profitable. If, for example, you know you're not going to be profitable for the next 8 months, it's an estimate, obviously.
Yes.
But with this app, for example, or your salon, you're not getting the market share you wanted, and you know it's going to take you another 8 months when you survey the market and your partners and so on to get to that scale that will cover your costs so that you start breaking even and then actually recording a profit. That means that compared to, say, if you only have a cash runway of 4 months, means your default dead.
So where is the, default alive, default dead? Where is the distinction? Where is the differentiator?
The differentiator is simply that if it's going to take you longer to hit profitability than the time that you have to burn through cash right now, you're default dead. It means that you would have run out of cash before you start hitting profitability.
So once you do your projections, say someone is pitching, they give you the numbers and you see this, and this is a default dead situation, you walk away as an angel.
No.
What
Interestingly, you don't have to.
happens? Okay.
In fact, and this is a beauty about, I guess, the accounting mindset that we tend to have is that, we talk about double entry. You'd have heard of that,
Yes,
debit,
yes,
credit.
yeah.
There are always two sides, if not maybe more sides to an equation. And in this case, Mogobe, the side would be, you'd say, listen, entrepreneur X, you are actually going to run out of money in the next 6 months. You and I know that, face those facts.
Yeah.
But you only expect to hit profitability in 12 months. So guess what? You need me to inject much more in the short term. And that means it affects a couple of things. It affects the valuation of the business. That's one thing. It also affects the point at which you come in, how much you contribute, and what kind of stake you get in return for it. So it could actually be, if it's a strong value proposition, and there is a clear path to profitability, it could actually be that you are simply making the difference between their cash reserves and their funding or not.
You've just triggered a thought in my mind. I read somewhere that when Amazon was being set up, Jeff Bezos ran at a loss for 7 solid years, and now he's the wealthiest man on the planet.
Yes.
Help us deal with that, because it's so difficult to conceptualize in the case of Amazon. And there's this 1,000 day rule that the gentleman who started Flow Tech, Mr. Nike, talks about a lot, and I've read about it, that your business should survive for the first 1,000 days. And if it doesn't go, if you don't reach profitability after 1,000 days or survive after 1,000 days, then maybe you should reconsider, which is roughly 3 years.
Yeah.
What are your thoughts on these points or these approaches to business?
Yeah, and they're quite contrasting, right?
Yes.
So I think that the difference is, and remember that Amazon actually, as it's famously told, started as a bookstore. So there's also a possibility that, unlike Mr. Naik, who knew exactly what he was going for, that Jeff and his partners were still figuring out exactly what space they wanted to play in, what they wanted to offer, and it kept morphing. But there's a bigger issue, I think, at play, and that is that apart from the entrepreneur needing to be absolutely clear in conviction about their value proposition and the fact that there's a market need for it, that even the market may not understand, as was famously the case with Apple in the early days as well.
Yes.
You see,
So both the market and the entrepreneur are learning.
exactly, 100%. That's a valid point. The entrepreneur has to have the conviction, but also has to be willing to accept changes and be able to pivot in their own strategy. And then I'd say thirdly is that who is the entrepreneur partnering with as an investor? And we can come to that much later when we talk about matching yourself with the right investor group, because again, in Silicon Valley, Cape Town, and tech hubs like that, even in Nairobi, you'll find that you have a certain pack of investors who know that they want to invest in technology. And they've already said, I know I don't expect to return in 7 years' time. So once they give you, as the entrepreneur, that runway, it's giving you the license to build your business.
Yes.
If you don't have that support from your investors, it's a completely different proposition. And either you've got to look for new investors, you've got to probably look at your business model as well and modify it to what they want.
Sometimes you have to give away more equity.
You have to
get
give away
diluted,
more.
Yeah.
Absolutely. Yeah,
okay.
something has to give.
Yeah.
But I think as I say, it depends on your industry sector, your business model, and the investor pack that you're working with.
You mentioned, just as a digression, you mentioned Silicon Valley, and you mentioned also in Kenya, a hub. How are we doing in Botswana? How is our hub doing in the global context? We want to be world class, and we strive to maybe emulate those jurisdictions. In your opinion, are we heading the right direction? Are we winning in terms of getting to those levels as a country?
I wouldn't say we've won yet, and maybe we'll never say we've won, Mogobe, because it's a constant journey. And as we grow, the dynamics of the environment and the economies change. Even the social demographic changes. But as I said earlier, I think we are on a very positive path. And I'll tell you why. I think this is one of the most enabling economies, certainly in the Southern African sector, in my view. One of the most enabling economies for private and entrepreneurial growth. And the reason I'm saying that is I can see a confluence of various factors. One of the factors is that obviously with a drop in diamond revenue, COVID-19, we couldn't have the session without mentioning it once.
No, of course.
Everybody mentions it.
We're in the middle of it, yes.
I was saying the other day, COVID-19 blames COVID-19 for things. We mention it all the time, but it's inescapable that because of COVID-19, there's been both an accelerator and a regressive effect on the economy, right? So what I have certainly seen is that with the government necessarily needing to divert some of their spending budget to these emergency responses, its own stimulus into various sectors like infrastructure, even medical, teaching, education, has had to take a back seat. What that's meant is that job creation, downstream, work and employment, and therefore earnings potential has been directly impacted. But what you've seen compensate for that is, as we said before, the youth. Is it a correct figure to say 20,000 people graduate from the UB alone per annum?
It's possible.
Yes,
it's conceivable.
That's the figure.
20,000, maybe all the universities, maybe all tertiary, maybe.
Maybe, but I've actually heard 20K from the UB.
Because it would be less than 20K graduating because the population is about 25K, isn't it?
Right.
So of those...
in tertiary.
Those
possibly.
who are in the final year will probably be a quarter of that number.
Right.
Yeah.
Right. So where do those people go for work now if the government is actually needing to tighten its belt on its own, investment and spending and redirect it? They are starting to think, I need to do this for myself, right? So there's that kind of spring of entrepreneurial spirit. On the other hand, you have the likes of the government's innovation hub, BIH, that we work closely with as A&B, right? There is also CEDA that has come up with its new guidelines that in fact is almost, that set of guidelines is almost a disruptor to the banking sector because it's offering very low,
very little security at the beginning.
Very low barriers to entry for funding.
Yes.
Presuming that you've put all your ducks in a row as an entrepreneur, you've got Leia, and you've got so many other big corporates. Lerumo is one of them. You've got Botswana, that's another one.
You spent, what, 10 years at?
I spent 10 years at Lerumo, which I think planted that seed of passion about social enterprise, certainly. But all of these big corporates, as well as government, are investing so much into enterprise development. That's a space I'm going into now through my consultancy as well. And I think the major point is that all of those various factors are converging, and it's creating a good platform for great entrepreneurs to blossom in Botswana. So I wouldn't say we're winning yet, but we're on the path to victory.
It's encouraging. Listen, let's talk a bit more about the numbers, because you say that numbers are your friend, and one of the points we make, numbers are your friend. Weekly at the worst, tips, they should be at the tips of your finger. Those are the 3 points that I'd like you to just sort of unpack and how do you get the entrepreneur to fall in love with numbers? Because the tendency is to say, that is for my accountant.
Yes.
Those are for my bankers. That's for my financial people.
Yeah.
Yeah.
Yeah, I'm just going to worry about marketing and being the face of the business or the product development.
Yes.
And I would simply say this, if you have the conviction and the passion for your business as an entrepreneur, the belief that this is a business that ought to grow and become something significant, then you cannot do it without telling a compelling story, right? I haven't mentioned numbers yet.
Yes.
But you need to tell a story that is so compelling to your investor community, to your staff, your teams, to your customers, that they buy into the brand, that you have to at some point link it with data and factual points. And data and factual points that emanate from something as indisputable as cash, as runway, as equity, you know, as profitability. I think that those then really make your case a slam dunk. So an entrepreneur, you know, often I've spoken to some, and you've spoken to others as well with A and B, they come to us and they blank on their financials, right?
Totally.
Yes.
I mean, we had just for the benefit of the viewer, we had a pitching session where we had roughly 25 entrepreneurs, and of those, there were only just 2.
Yes.
Or literally 2 who seemed to know their numbers and
Correct.
appreciate their numbers.
And those were the 2 that we said we want to take forward.
Yes.
So that's a case in point. But the reality is that if they're able to compellingly narrate how their business translates even into customer numbers, transaction volumes, you know, hits on an app or something like that, or a website, or followers in your feed, that then translates for the investor as something that is investable into. And so it's vital. Also, in your early days, we talked about the valley of death. Particularly if you feel you're teetering on the brink of the valley of death. You as an entrepreneur cannot possibly expect your bookkeeper, who's an occasional entry into your business team, your bookkeeper to jealously watch the amount of cash that you have to play with and so on. You need to own that as an entrepreneur.
Yeah, I have a system where I ask my bookkeeper to update me daily on what's happening with the cash. I think it's very, very important. All right, now I want us to talk a bit more about multitasking, you know, in the context of, is the entrepreneur being realistic with regard to the costs?
Yeah.
Yeah.
So that's another thing that I've typically seen, and I think it's an understandable pitfall in that often as entrepreneurs we are so fired up about what we want to do that there are certain blind spots we tend to have, and one of them is certainly the level of cost and investment it's going to take to drive this business forward. In the early days, you know, acceptably so, you'd find an entrepreneur is doubling up. They are the sales force, they are the product developer, they are the marketing person, and they probably are doing some of the accounting and finance stuff as well.
As well as being the face of the company.
Absolutely, the brand of the company, and then leading a team as well. So they're taking care of human capital too. And so they double up a lot, and they don't put a price on that time that they have invested. But remember what we said at the outset, that capital isn't purely financial. It's human, it's intellectual, it's natural, it's even based on social and relationship sort of bonds. And so if an entrepreneur isn't saying, listen, yesterday I spent one whole day with the developers working on my website, which day I therefore didn't spend clinching those other 2 orders. And those orders would have gotten me 50,000 pula in revenue. That's the opportunity cost of that entrepreneur's time that was spent working with the developers, which notionally they should put in as a cost, frankly speaking. And why is all of this important? Because now when you stand in front of investors who don't necessarily share your passion for the business,
at least not yet.
Not yet.
You have to convince them.
Exactly. You have to bring them with you. And they haven't yet got your level of investment into what you've sunk in the business, right? So you've got to now get them to understand that this is an investable business. And if you've understated what it cost you, both in financial and other notional capital terms, then that becomes something that discourages investors typically when they see that you've understated your costs.
Yeah. Talk about brutal honesty, and one of the things that I've observed in shows like Shark Tank, you know, there's a gentleman who calls himself Mr. Wonderful, O'Leary, and he says, you know, money is, you should never cry about money because money never cries about you. He says things like that. So you talk about brutal honesty, and I'm thinking to myself, sometimes when you say to an entrepreneur, where is proof of concept? Where is the demonstration that this thing works?
Yes.
They think you're being too harsh.
Yes.
So I want you to talk about that aspect, brutal honesty.
Yeah. Look, I think if it gets to a point where an investor has to be the first person to give an entrepreneur those kinds of, stare in your face, brutal truths, then you need to introspect as an entrepreneur. Certainly, being an entrepreneur requires a truckload of courage, and I wouldn't sit here and say for a moment that I think we can all do it. We're not all cut from that cloth. You have to be resilient and you have to have courage to take these risks, but you certainly need to do yourself the favor of being honest with yourself, and that means being honest about whether, this street that has 3 hair salons needs a 4th one. Okay? And what are you going to do that is so great and distinctively different that customers who already have 3 to choose
Will
from
gravitate towards you.
to you. And you've got to be honest with yourself, because if you are not, you'll get to a point in the road where life or investors or customers will give you that honest truth.
Okay, then fixed versus variable cost. I think you've touched on this, but maybe you could give an example in the context of some of the companies you've worked for, or in the context of your own consultancy business.
Absolutely. So, in fact, let's take the last point first. My own consultancy business, I'm actually developing my website myself. And I am basically I am a technophobe. I think that's the word, right? Tech hates me, and I don't necessarily do very well with it. But I'm doing that because I believe at this point in the nascent stage of my consultancy business, I can't afford, the heavy cost of a developing firm to do my website, when there are the likes of Squarespace, Weebly, or whatever that are out there that can help you develop your website from a set of basic rules that have already been coded. But let's go to the other extreme and say even small, medium, large corporates, such as say Lerumo, would have done. There's that conversation that you need to have about what kind of cost structure your business should carry at any point in time. And in the early days, definitely for a startup, and even if I took a Lerumo and we looked at one of their investee companies across the continent, what you'd be looking for is that you can flex your cost base in the early days, because you're still not 100% certain, and you probably never will be, but you're certainly less certain about the level of revenue and volume that you can do in terms of business. So in the early days, you don't want to go for a large warehouse that is on a 5-year lease. You know what I mean?
But can an argument not be raised, using a consultancy as an example, that since you are a technophobe, if you're going to be spending all that time figuring things out, something that would probably take you 2-3 days will take a tech-savvy person a minute. I have a situation with my daughter. She's 15 years old. I'll be fiddling with the phone, trying to load something or trying to upload something, and I'll be working because of my ego. I would spend maybe an hour trying to figure it out until I give up, and she'd do it in a split second. Don't you think there's that consideration as well?
There is that consideration. The difference is, I'm saying I don't have the revenue to cover the cost that I would incur when paying a third-party developer. And I've balanced it with, and it's probably not the best example to have used, to be fair, but I've balanced it with the fact that, frankly, you've got a ready-made website. All I'm going in and doing is changing name, details. I'm not doing anything to do with design. I'm not doing anything to do with elements of
just
development.
Cut and paste.
Sort of, it's really using the content that's already in my head about the business and putting it into an existing format. But if you come back to it, it's about making sure that in the early days, you basically don't create too huge of a fixed cost base, right? So in the example I was also giving previously, if, for example, you want to be a distributor of, natural products, skincare products in Botswana, you need a place to store them. Are you going to go for a 5-year warehouse lease, right? Or are you going to go for maybe a 6-month one for a smaller module? And when you see that the volumes are picking up, you then scale up in response to the business.
I would suggest you take a 5-year one, but with a termination clause.
Fair
in
enough.
case things get bad.
Absolutely.
Yeah.
Thank you, Mr. Lawyer. Yes, and the termination clause should not be punitive.
Yes.
Is the point. You should be able to, and that's the point I guess I'm really trying to make here, is that your cost structure must be one that is flexible enough, right? Again, if you take, the reality is probably to exit that warehouse at that point in time may be difficult and painful. Whereas to scale up with a second module may be easier to do. So you've got to make that balance and make that call for your own business.
Absolutely. The CEO and team need to own the numbers. Ownership of the numbers has two aspects: outsourced resources, and also the CEO and the founder. I think we've touched on this, but I think it bears repeating just to make a point and drive it home.
Yeah. Yeah. So, even as you grow and you're scaling, and now you realize that as a CEO, there's an opportunity cost to me building my own website. When the business is now maybe 18 months old, I have 10 or 15 steady clients. They need the CEOs or the founding partners' time, right? On the front lines. And so the CEO needs to necessarily build out a team and needs to start delegating more and more. And the rule that I like to use is the 1-2-4 rule, meaning that, when you're at the level 1 of your business, you scale down, or you make sure you limit your costs and your resources and so on. When it doubles, you match the resources that you put in. And when it doubles from the level 2 to 4, then you match your resources. But nowhere in that point of that journey can a CEO not have the core numbers at the tips of their fingers, nor can they sort of abdicate responsibility to the CFO or the bookkeeper or a third-party firm like the lawyers or whatever the case might be. So the CEO and whichever team she or he is building out need to understand that they are accountable for and responsible for the results of the business, as well as then the forward-looking plans and projections.
I want to talk about scale, but I before we really delve deeper into it, I want you to explain whether scale is a necessity for survival, or scale is, as in growth, is inevitable or unavoidable for a successful business.
I think scale has to be taken in context. So, when we talk about scale, we're saying what level of operating efficiency as well as volume do you need to be at to give you the return that you are looking for? And that doesn't need to be that you are at the scale of a multinational. It can be that you are at the scale of 3 hair salons that have a particular niche where they deal with a certain kind of hair type or something, and they go and locate themselves in certain specific regions, right? And with that model, you're able to give your capital a 20% return. If you limit yourself to just the scale of those 3 salons, but you're giving yourself the return you are looking for, then I think you're at the right scale.
So then it tapers into my next question. How do you know whether you're scaling too slow or scaling too fast?
That's a tough question. The biggest pitfall, I'd say, you will tend to have as an entrepreneur, I know I'm having it as well, and you've probably gone through it in your early days, is you go to a fellow entrepreneur and they say, hey Munna, I started this thing, and I have a team of 20, and you're thinking, I only have a team of 5. Am I maybe not at scale enough? And I need to keep up. Am I too small? Do you know what I mean? And that's the biggest mistake we can make.
It just reminded me a terrific story. One of my mentors, I won't mention the name, who was in India, and he, very successful businessman, he was mentioning that he's employed 2,600 employees.
Wow.
And then there's this young 30-year-old entrepreneur who says, no, I'm now working on my, I've employed 65,000 people, but I'm pushing another 10,000. And it felt so small. but then
So why I say scale needs to be taken in context is exactly that example. You see, your mentor, who is clearly a veteran in business, had a workforce that was not even 1/30th of the other guy's workforce, right? Yeah. Or something like that. But I'm sure he was vastly profitable.
Very
and
successful.
very successful. The business was sustainable and it was growing.
Mm.
So he was at the right scale because his top line was here and he had minimized his costs and he was doing so much more with less. And that's the right kind of scale to be at in whatever relative point on that linear scale you are on in terms of cost space, right? So I think that's one element of scale, certainly. But so it's about making sure you sweat the resources you have to get to where you get to in terms of revenue.
And is scale, is it measurable just in terms of employees and numbers, things growing, or there's an underlying measure that you look at? You know, can you scale just by growing the brand in terms of brand recognition without increasing the numbers? What I want to know is your definition of scale simply just adding, you know, I don't want to employees to the payroll, or just increasing your burn rate?
Yeah,
you know?
I think it can be many things, right?
Yes.
And it again depends on the kind of business you're in. So if you took, say, Letzecho or any financial institution, typically their scale is measured by their balance sheet assets, right? What are their balance sheet assets? If it's in the 10 billion pula mark, which is about $1 billion US, then that's some significant scale. And you're probably a player who's amongst the top 50 by asset size across Africa, right? But then if you
So it's based on the valuation.
It could be the valuation of your assets, it could be the valuation of your equity, it could even be your earnings, your EBITDA. But for certain companies...
You need to explain that. Somebody's
So
going to
that's-
write on the show notes, what is EBITDA, Mr. Mogobe? And then
So-
I'm left with explaining when you're gone.
So EBITDA is your earnings before interest, tax, depreciation and amortization,
Yes.
which is effectively your cash profit. That's simply what it is. It's your profit, but you've taken out all of the accounting type of entries that were put in above the line.
All right. So employees ratio, tracking your I talk about that one, tracking your revenue through an employee ratio.
Yeah. So, I mean, it comes back to the scale conversation because when, for example, you are at your very early stages of a startup and it's yourself and, say, your brother or a friend, literally are the only people, then you're the only two employees, right? And if you make a revenue of, say, 20,000 pula per month, effectively that's a revenue to employee sort of ratio of 10,000. But when then you add 10 employees to that, or let's make it a round number, add 8 employees, so you get to 10, a workforce of 10. But your revenue has only grown to, say, 40,000 a month.
Yes.
Yet now your revenue to employee ratio has dropped to 4K.
Okay.
Right, and that means that you are not sweating your workforce as much, or something is not right in the dynamics, and you've got to now go and rejig it. So it's just one of the many important indicators that you look at to assess whether you have scaled too fast or you're not scaling fast enough.
Okay, we're coming to the close of our conversation. I'd really want you to commit that you'll come back, because there's a lot that we still have to unpack and discuss. But as we do, would you want to share with the listener your assessment of the entrepreneurship landscape in Botswana, and where you think we need to spend more time in terms of improving our output and our performance as entrepreneurs in Botswana in particular?
Yeah. So, I mean, let's first look at what I think is going right, maybe. Because then if you know it's going right, you don't have to work that hard on it. You need to obviously make sure the systems are in place to keep that at that par at minimum. But then it helps you to then focus on what isn't going so well. So I think that we've got a government that has invested significantly into the educational system in the country. And either by virtue of sending meritorious students abroad, or having the right kind of faculties in Botswana to teach people well, you've generally got a youth and potential workforce who are fairly well educated, they're fairly knowledgeable, and they're certainly incredibly bright. I mean, in my experience, people blow my mind every day here. So you've got that, and that's what I think is a tick. That's what we have.
Plus,
Yes, we have it going for us, whereas you go to certain other countries, even in neighboring Southern Africa, and the levels of literacy the levels of numeracy or understanding of your environment are not as high. So it's certainly something that I think we need to give credit to the government for. There's that. And like we said earlier, you have the institutions that are here to seed fund and support young enterprise, right? So BIH is one of them, LEA, CEDA, and many others. And those are, again, things that we have going for it. We've also got the fact that the government is pushing.
But are they effective, those institutions?
Oh, now you're making me say political things. I think they're sort of figuring out their place in the entire funding and enterprise ecosystem.
Yes.
And I certainly think that there is an aspect of being a development funding institution requires levels of credit risk governance that are probably up there when the entrepreneurs' risk levels are up there. Okay, and we need to find a way to help all of these institutions get to that point of comfort. And that's why angel investors become important, because they help to create that stopgap while the business legitimizes itself, builds a track record of delivery, and then can take that track record of evidence to these DFIs where they are slightly de-risked development finance institutions or development funding institutions.
Yes.
And so examples of those are BDC and CEDA in Botswana. But coming back to, I think, what then needs to happen. So we've got a good educational system and smart youth, and you've got enabling organs such as all of these DFIs, as we call them, right? And enabling policies as well from the government around economic diversification, which frankly, I'm sure there's room to improve them, but we can work with what we have. You know, in agribusiness and education, the current president wants this to be a knowledge economy. You know, there's so much around education that can be done, and the technology platforms and stacks that can be built under it to drive that and scale it across the continent and beyond are there. The potential is there. What I think is sorely lacking is this financial numeracy, right? So this financial acumen,
Numeracy,
the skill
as
level.
in literacy.
Yes, but not literacy about, you know, general topics, but literacy about what is it going to take for me as the business owner to make this business float. And it's topics like what we've been discussing, right? That I think
which
oftentimes,
I'm going to invite you to discuss even more. I think I'm going to be calling you more and more to go deeper.
It would be my pleasure.
Okay, listen, this is the part of the show when you get to ask me a question, any question that pops into your head, within reason.
Maybe it won't be within reason, and you'll tell me.
Yes.
Flat out like a good lawyer.
Yeah.
Mogobe, I haven't known you all that long, but I feel like I get you at a level in terms of our value systems. They seem to correlate quite a lot.
Yeah.
And for me, where I come from in terms of my upbringing, I've taken a big leaf out of my late father's book around a life of belief and purpose. That's what he always taught us as children growing up, and that's how he lived his life. So if I then relate that to you, and given the lifespan you've had already, what would be the one greatest dream that you may have even harbored as a boy, as a young boy, which you really would like to see being realized in your lifetime?
Yeah, I've never been asked such a tough question. But I try not to take myself too seriously, so I would not have taken the time to really analyze it deeply enough to come up with a ready-made answer. But at the beginning of this show, I mentioned that we want to enthuse, to energize, to empower, and to inspire. We see these four things. So I think part of my purpose is to do these four things continually in the entrepreneurship space. I believe that if I do that, not only do I enhance my own position as an entrepreneur, but more importantly, I empower others and I improve the landscape. And I get the wonderful opportunity to interact with wonderful and intellectually potent people like yourself who are able to empower me in the process. So if I can improve the life of one entrepreneur, if I can empower one entrepreneur, inspire them, I think my purpose will have been fulfilled. It's not something that is necessarily measurable, but to me it's a work in progress and it's an ongoing effort. I want to devote my life towards that effort. As to your question of what I would like to see accomplished, I believe that entrepreneurship is the change agent for this country. We say that the private sector is the engine of growth, but I'd like to narrow it down and say entrepreneurship is the actual engine of growth. If an average Motswana can embrace that, I firmly believe that we will be world class in terms of being comparable to the Dubais of this world, and so on. We're already at a huge advantage in terms of, political stability, in terms of the governance systems that you talked about. So I don't know if I've answered your question, but I think I've fumbled enough to create the impression that I have.
But I think then, based on what you've said, I could connect that to what you consume your days doing. And it would seem like you're following your greatest dream or your greatest passion. That's what you're really spending a lot of your time doing.
Yes.
And I think that's the most important point for me when I go back and think about entrepreneurs is while they're doing this, facing these challenges, trying to keep away from the valley of death, facing tough investors, Shark Tank type angels, are they chasing their dream? And are they doing it in a way that if this will be the day we breathe our last, we can do it with happiness and contentment, that we were chasing what meant the most to us in terms of our life's purpose. And I think you've said you are doing that.
Thank you very much.
So that's greatly impressive, and I think that's a great note to leave your viewers on, to inspire them with.
Yes. Now, this is a time when you now look at that camera and leave them with something inspirational, a big takeaway. And when you do, tell them that the story has not ended. You're coming back, and I'm actually going to invite you as a guest. If I can, every 6 weeks or so, every 2 months or so, at the minimum, I want to invite you back because I think these topics need to be developed more, and we need to keep talking about them.
Right. Okay. Thank you. Thank you again, Mogobe. So, listeners, viewers, I would leave you with what I would say are two platitudes, and I'll tell you why they mean so much to me. So the first is that the purpose of life is a life of purpose, and what I mean by that is that we don't yet know fully why we ended up where we've ended up, but certainly if we can spend every moment of our time seeking purpose where we add value as individuals, that all adds up to a greater national and even global benefit. And I think if each of us at our personal levels just made that our mantra every day, where we sought a purpose in every moment that we get to breathe in oxygen, we would make the place better, that our environment better. The second platitude is that work is worship. And I learned this from my parents, certainly, and I've seen it play itself out in my own life. I found that even when you're going through the toughest of times and you're working incredibly hard, you may feel undervalued, underappreciated, underrewarded, but the rewards always come. And that's because when you do something with the right intent, and when you have the humility to understand that in doing this work that is worshipful, which is with the right intent, you may trip and fall, you may hit a brick wall, you may be told you're on the wrong path, but you are willing to have that worshipful attitude towards work and life and your purpose, you will keep being directed in the right way. And that takes you to a higher place of enlightenment for yourself. That's important because we can't go through this path as entrepreneurs without having a very strong inner compass. And I think for me, those would be the two. Try to lead a life of purpose and believe that your work is your worship.
Thank you. Just that topic, work is worship, is worth inviting you back to come and discuss further.
Thank you.
How do the listeners get hold of you? Are you contactable? How do they take advantage of your immense experience and knowledge?
Thank you. So as I said, I'm busy setting up my firm now. It's registered, but I'm getting it registered with BICA as well. So it's formed under SIPA. But you can find me personally on LinkedIn. I'm sure Mogobe's team will put my name up. on this podcast after this.
Yes.
And you can look out for me on LinkedIn. I try my level best to answer everybody who writes to me, which is not to say that there are a lot yet. But I'm most interested in talking to people who are looking to do something and contribute something, because I've always got something to learn
So what
from
is
them.
the handle? It says Mythri?
It's Mythri Sambasivan George.
Okay.
So really long, so you need to put it up on your
Yeah, I will.
video.
So on any of the platforms like Facebook?
Oh, I try to avoid Facebook,
Okay,
my
so
apologies,
just
but you can
LinkedIn.
find me on
Okay.
LinkedIn. That's
All
the
right.
best place.
All right. It remains for me to honor you, to thank you, to appreciate you, and to tell you how enthralled I am about your presence and this interview. Thank you so much for
Thank
coming.
you so much. Thank you for having me.
Okay.
Thank you, everybody.